Welcome back to Open Line. We are talking about taxes and your money. We have with us Dr. Friday, tax specialist. Always happy to have her here. Lots of calls.
Yes.
People have lots of questions about money. I mean, when you were giving out free advice like this, why not call in and take advantage? All right, let's go to Nancy. Hello, Nancy.
Hello. Thank you for taking my call. Okay, my husband and I, we get Social Security only.
Okay.
Do we have to file taxes?
You do not, and that's an awesome question because there's a lot of people listening. Thanks for calling in and asking that question because there's many people listening that have. If you only receive Social Security benefits, you do not file taxes, period.
So that's good news.
That's awesome news for them because it's tough enough to live off Social Security as it is. So, you know, at least one less thing you don't have to deal with, taxes.
Very good, Nancy. Thanks for the call. Let's go to Shelley. Hello, Shelley.
Hello.
Hi. What's on your mind?
Yes, I receive Social Security disability, and I have a child. I've actually had her since May. She lives off of my income. I recently got custody of her, so can I file taxes? Being that I take care of the child on my income?
No, unfortunately, because disability is not considered earned income, and child credits and earned income credits are all based on the fact that you earn income. Disability is what it is. You know, it's a supplement. So there would be no tax credits available to you at this point because there's no place on the tax return to actually put it to generate any of the credits.
And is she's talking about dependents?
Right. So she took on a child, even though she's disabled. She took on a child and somehow got custody of this child, and now there's two people living off her disability instead of one, possibly. And she was trying to find out, is there a reason to file taxes? Because there's child credits and just, you know, things like that. But in her case, all those credits are issued to people that actually work or have earned income, and disability is not considered earned income.
And that's one of those areas, dependents, where there's a lot of debate and fight.
Oh, that's a whole subject. We need to do a whole show on who is truly a dependent and who can really claim the child and who definitely does not qualify for earned income credit.
We may get some questions on that. Let's go to Brent. Hello, Brent.
Hello, guys. I've got a question about capital gains.
Okay.
I know that you can sell your house and not have to pay taxes. But if there's a farm associated with that house, can the revenue generated from the farm also be counted in the same way? I'll just hang up and let you guys answer.
Okay. No, a farm in the eyes of the IRS is a business, even though it's a farm, but it's still considered, and you file those on Schedule Fs. A farm is not a house. Residents are, your primary residence is what you can claim and pay, and you get the waiver of $250 for a single person or $500 if you're married above what you originally paid. So you get some waiver of capital gains. Most of us will not usually hit that threshold, but I have a few that do. But in answer to your question, a farm is a business, and a business does not meet those particular qualifications for waiver of that capital gains.
And you're talking about your personal residence, the rental property.
It's an investment property.
So you have to pay capital gains on that.
Yes, exactly. Now I have people that move into their rental property, live in them 2 out of 5 years after they've sold their primary, turn in a rental into a primary, live in for 3 years or so, and then sell it, and they do have to recapture, but there's still the exclusion would work.
Interesting. Let's go to Karen. Hello, Karen.
Yes.
Hi, go right ahead.
Yes, my question is, my father is a dementia patient and had a caregiver taking care of him, and basically she committed elderly fraud against him, taking all of his savings, everything that he had, and his taxes have not been filed since 2012, I believe. So I was wondering, is there a penalty associated with not filing? We were not, we just found this out that he had not filed taxes since 2012. He is, of course, disabled at this point, and there is a huge loss now that is in a 3-year court battle over $185,000. So I guess my question is, would that loss offset, anything that he would have had And does he need to file his taxes?
Well, that's it. You know, you still need to file the taxes, and then if he gets an NOL, he gets that loss carryback. We can roll it back 3 years and roll it forward 20 years if you choose, and so we could take care of some of his possible tax issues. As far as penalties, I think he probably have a good reason, you know, to possibly get some, if not all, of those penalties waived. But you know, the first step this year, 15, make sure there's an extension filed at least, so that way the time clock, you know, is started and you have the ability to get all the other years. If he owes money, if he doesn't owe money in those years and he has refunds, you're leaving it on the table for 13 and 14. So you really do need to, you know, have somebody help him put the information together and find out one way or the other what's going to happen, because if he has this, and they can live a very long time with dementia, so, you know, one doesn't mean that he's, you know, has a situation. So all I'm saying is someone needs to get in there and get him straightened out so that every year his taxes are filed, and then if he wins the case, great. If he loses the NOL, or if he doesn't and he can claim that loss carryback, you can wipe out some of the taxes. But the IRS has to know how much you owe before you can wipe away taxes.
All right, let's go to Beverly. Hello, Beverly. You may have to turn down your TV.
Please.
Turn down your TV.
Hearing me once is enough.
Yes, we'll go to Thomas. Then we'll come back to you, Beverly. All right, Thomas, go ahead.
Yeah, thanks for taking my call. I've got 2 questions. I presently live in a house that I inherited from my mother approximately 10 years ago.
Okay.
And what type of taxes will I expect to pay when I sell this property?
Well, it sounds like it's your primary residence now, since you've lived in it 10 years. So unless you sell it for more, if you're single, more than $250,000 from what it was worth 10 years ago at the time of your mother's death, you really need to know exactly how much the home was worth, because that is your cost basis. And so whatever it was worth then and what you sell now, if it becomes a rental between then it's a whole different conversation. But it sounds like it's your primary residence. So zero tax unless you're going to sell it for more than that, and then capital gains can be 0 to 22% thereabouts.
And he's lived there so long.
Right, so he meets the complaint. You know, I would definitely, if he wants to sell, I would sell while it's still his primary, so he gets at least that waiver of the first 250. I mean, depending on, back 10 years ago, the market wasn't as good as it is today, possibly, so he could end up with a fairly decent, you know, increase or capital gains.
All right, let's go back to Beverly. Hello, Beverly.
Hello?
Hi, go right ahead.
Oh, yes, hi. I purchased a duplex in mid-2015, and I've been making improvements. I'm not quite yet finished, so I have yet no rental income. And my question is, I'm living on the one side as my resident. Am I able to claim any of the improvements I've made for the rental side, even though I haven't had rental income?
Not yet. You will be able to depreciate that when the rental income, when it actually goes on the market and becomes an actual rental. So you're not going to lose it. So you want to keep good records on how much you did for improvements on the rental versus your primary or your main home, because whatever you do in your main house is not a tax write-off, but what you're doing in the rental can be a tax write-off. So therefore, you want to keep good records. You're not going to lose it, Bev. It's a matter of just documentation, and you might not take it until 16 sometime.
Okay. All right. Thank you.
Thanks.
Thank you. Let's go to Nancy. Hello, Nancy. Nancy. All right, we'll come back to you. Turn down your TV. Brent has a follow-up question.
Oh,
yes,
cool.
Brent.
Yes, I hung up a little too soon on you guys a while ago. My question is, this land that is connected to this house that I'm thinking about selling is not actually a farm. It's just wooded acreage. So if it's not a working farm, that is kind of what I wanted to interject.
Okay. Yeah. Well, look,
Different.
that's a good question or a good response. But the other side of that is you have to sell all or nothing. So if your primary home, and there has to be a house to be a primary residence to get the disclaimer or the exclusion of 250 or 500. So if you're selling off a part, of your primary house, basically land, then you're going to have to come up with a cost basis, because when you purchased the whole property, you paid so much for the land and the house and everything else, and you might want to reduce your basis of your home and put some basis into that land so you don't pay 100% capital gains on that. But you still won't get the exclusion on when you split it. You're basically saying this is investment and this is primary house.
Okay, well, I'm not talking about splitting it.
Okay.
I'm talking about selling it all together.
Oh, well then, yes. If you're selling the entire thing, the house, the land, everything at one time, then I'm backtracking and putting myself right there. Yeah, then it's your primary home sold, no matter if it's on 30 acres or a lot.
Really? So
Right.
an entire farm?
The entire farm, right. It's going to have the initial exclusion. Now, he may be able to sell that for more than, he may have
Right.
some additional capital gains because of the increase in the land.
Oh, but he gets the initial exclusion.
He'll get the initial, yes. So, yeah, you will get the initial exclusion if this was your primary home, your primary residence.
All right. Let's go back to Nancy. Hello, Nancy.
Hey,
Hi, go right ahead.
I just want to know, I'm recently widowed, and I'm just trying to find out, do I file as head of household or do I file as single?
When was the passing?
I'm sorry?
When did you lose your spouse?
4 years ago.
Okay, so you file single unless you have a child. Do you have a child?
He's over age.
Okay, so you would be single because the head of household would mean that you had a dependent. It sounds like you don't. So at this point, just you, single on the tax form.
Okay, so if I filed head of household, does that change the rate?
Absolutely, head of household gets a higher exemption than single. So a lot of people make the mistake thinking they're head of household. Not always sure why. Some head of household with their dogs. But yeah, head of household is a particular thing, and you need to have a dependent. Now that dependent can be your mother or father that live off Social Security theoretically if you're providing more than 50% of their care, but there is certain rules you have to document. They have to live with you. You have to get more than 50% of their care. These kind of things to justify that.
So not head of household. If you're
Not
living
head of
alone.
household.
Okay. All right, we'll take a break. If you want to call, a few lines are open. 615-737-PLUS, 615-737-7587. Take a break. Be back right after this.